Buying full downside protection often creates more portfolio drag than the market crash itself. Here is how to calculate if the cheaper coverage is sufficient. Every trader wants to insure their portfolio against a crash, but premium costs can eat all your annual gains. The dilemma is always choosing between perfect protection that is too expensive or affordable protection that might fail during a total collapse. Today, we compare the protective put against the vertical put spread to solve this cost-benefit equation. Let's define the contenders. The protective put involves buying a single long put option, giving you the right to sell shares at a specific strike price no matter how far the stock falls. It is the gold standard of insurance because it creates a hard floor for your asset, completely uncapped to the downside. However, this hard floor comes at a premium that significantly raises your break-even point. To profit, the stock must rise enough to cover the cost of the put option. If the market stays flat, the insurance premium expires worthless, acting as a direct drag on your portfolio's performance. Enter the put spread, often called a bear put spread when used for hedging. Here, you buy that same protective put, but you simultaneously sell a further out-of-the-money put against it. The premium you collect from selling the lower put finances the purchase of the protective put, drastically reducing the net cost. The structural difference is critical. The protective put offers protection all the way to zero, while the put spread only protects you within a specific range. Once the stock price falls below your short put strike, you stop gaining protection and you participate in the losses again, though your losses are cushioned by the spread's profit. Visualizing the payoff diagrams side by side reveals the trade-off. The protective put line stays flat regardless of how deep the crash is. The put spread line protects you for the first leg of the drop, but flattens out, meaning you are exposed again if the market crashes through the floor of your spread. Why would anyone accept cap protection? It comes down to cost efficiency and probability. Let's look at a hypothetical $100 stock. A 3-month protective put at the 95 strike might cost $4. That is a 4% insurance premium required every quarter. Now, let's turn that into a spread. You buy the 95 put for $4, but sell the 85 put for $1.50. Your net cost drops to $2.50. You have reduced your insurance cost by nearly 40%, but you are only protected if the stock falls between $95 and $85. This brings us to the coverage gap. With the spread, if the stock drops to $80, your hedge pays out $10, the width of the strikes, but you lose $20 on the stock. Your net loss is $10 plus the cost of the hedge. You are mitigating the disaster, not eliminating it. However, statistical analysis favors the spread for most market conditions. The vast majority of market corrections are between 5% and 15%. The put spread covers this likely zone perfectly at a discount, whereas the protective put forces you to pay for apocalypse insurance that is rarely claimed. There is also a volatility component, or Vega risk. When markets crash, implied volatility usually spikes. A single long put benefits immensely from this spike, inflating its value. This acts as a secondary buffer during a panic. The put spread, however, is Vega neutral or close to it. Since you are long one put and short another, the volatility spike affects both legs. You don't get the same panic bonus in your hedge value that you get with a standalone protective put. So how do we decide? Use the protective put when you fear a black swan event or a systemic market failure where correlations go to 1. This is for when you believe a drop of 20% or more is imminent and you need uncompromised safety. Use the put spread for routine events, like earnings reports or anticipated 10% corrections. It is the cost-effective choice for known unknowns. You are essentially saying, I want to insure against a bad quarter, not the end of the world. A common mistake with spreads is setting the short strike too close. If you sell the lower put too close to the current price, you create a very narrow window of protection. You need to ensure the width of your spread matches the expected move volatility. Another nuance is legging in. Some traders buy the long put first and only sell the lower put if the market actually starts to drop. This creates a protective put initially, which converts to a spread to lock and hedge profits and reduce cost basis dynamically. Let's summarize the decision process. If you have a low tolerance for drag and want to hedge a specific event like earnings, the put spread is superior. It reduces the cost of doing business. If you are holding a volatile asset for the long term and want to sleep at night knowing your maximum loss is mathematically fixed regardless of a global crisis, pay the extra premium for the protective put. Ultimately, hedging is about trading potential profit for certainty. The put spread trades less profit for enough certainty, while the protective put trades significant profit for absolute certainty. Beware of time decay, or theta. Both strategies lose value as time passes, but the put spread suffers less from time decay because the short option you sold is also decaying, which works in your favor. Before executing, always check the implied volatility rank. If IV is extremely high, buying a protective put is buying expensive insurance. In high IV environments, the put spread is mathematically superior because selling the expensive lower put offsets the cost. Here are the top 3 mistakes to avoid. 1. Buying protection too late after the crash has started. 2. Selecting a spread so narrow it barely covers a daily move. 3. Forgetting to roll the hedge before expiration. This decision flow chart summarizes the entire strategy. Pause here to determine which path fits your current market outlook and portfolio size. Remember, insurance is a negative expected value bet made to preserve capital for future opportunities. Don't overhedge to the point where you cannot make money, even in a bull market. Choose the tool that matches the threat level. Calculate your max drawdown tolerance before buying the insurance.